All right. Hey, everyone, future Wall Street Titans. So you're young, you're ambitious, and I bet you clicked on this because you want to figure out this whole stock market thing, right?
Yeah, definitely seems like a good reason.
Welcome to the deep dive. Today, we are diving headfirst into a question I know is on everyone's mind.
What's going to happen in 2025?
Exactly. Specifically, we're looking at the S&P 500.
Ah, yes, the all-star team of U.S. stocks.
It's Apple, Microsoft, Tesla.
The big leagues.
It's like the Avengers, but for your money.
Love that.
So will the good times keep rolling, or is a crash coming?
That is the million-dollar question, isn't it?
It is. So let's rewind a bit.
Okay, back to 2022.
Yeah, 2022. Remember that? It was kind of a stock market horror movie.
Oh, yeah, it was down, what, almost 20%?
Almost 20%. Yeah, it was rough. But then 2023, things bounced back big time, over 24%.
And this year, 2024, is looking even better.
Way better. On track for over 25% gains. So where does that leave us for 2025?
Well, analysts are always trying to predict the future, right? And according to FactSet, they think the S&P 500 will end 2025 at just over 6,679.
That's a 10% increase.
3 years in a row of double-digit growth.
That's wild.
Hmm.
Since 1957, the average yearly return has been about 10%.
So it's definitely in the realm of possibility.
But let's be real for a second. Analysts aren't exactly fortune tellers.
That's true. They've underestimated the index in how many of the last 5 years?
Four out of the last 5 years, including this year, 2024, where they thought we'd end up around 5,132.
Wow, so they were way off.
Yeah, and over the past 20 years, they were more likely to overshoot by about 7% on average.
Which just shows how unpredictable the market can be.
Totally. Even the big names like Morgan Stanley and Goldman Sachs,
Oh yeah, what are they saying?
they're cautiously optimistic, predicting the S&P 500 will reach 6,500 next year thanks to earnings growth picking up speed.
Interesting.
But before we get lost in the predictions, let's talk about what actually makes the market move.
Yeah, what do you think, listener? Is it some secret society pulling strings behind the scenes?
Not quite.
Okay, good, because I was worried for a second.
So it's actually driven by some pretty basic things.
Like what?
How much money companies are making.
Right, corporate profits.
Interest rates set by the Federal Reserve.
Ah, the Fed.
And good old inflation.
A trifecta.
It really is. Okay, so break that down for me. I get that companies making bank is good for stocks.
Right.
But how do interest rates and inflation fit into all of this?
Okay, think of it this way. Corporate profits are the engine of the S&P 500. They drive the market's growth.
Okay, the engine makes sense.
Interest rates are like the gas pedal or the brake.
Okay, I like where this is going.
So if the Federal Reserve lowers rates, it makes borrowing money cheaper for companies, which can lead to more investment and growth, especially in tech.
And higher rates do the opposite.
They can definitely slow things down.
So it's kind of a balancing act.
Exactly. And then there's inflation.
Inflation, that tricky little thing.
It's like hitting a pothole.
It messes with how much things cost. Businesses get nervous about investing.
And that can ultimately hurt the S&P 500.
So it's all connected.
It's all part of the big economic picture.
Which brings us to the big debate. What's the bull versus bear case for 2025? Give us the good news first.
All right, so starting with the bulls, the optimists.
Okay, the optimists, what are they excited about?
One major bullish factor is the possibility that the Federal Reserve might hit the pause button on raising interest rates.
Pause.
Or maybe even cut them.
That would be like slamming on the gas for the S&P 500 engine, right?
Exactly. Especially for those tech giants who love to borrow money to innovate.
They'd be off to the races.
Potentially. But now let's flip the script and talk about the bears.
The folks who think things could go south.
Yeah, their biggest concern is that stubborn inflation we've been seeing.
If it sticks around longer than expected.
The Fed might have to keep those interest rates higher for longer, which could put the brakes on economic growth and stock gains.
So higher inflation means higher interest rates,
Yeah.
which basically throws a wrench in the engine.
It's a simplified way to put it, but essentially yes.
Got it? That makes sense.
Another thing keeping the bears up at night is the potential for corporate earnings to disappoint.
Because if the economy slows down, people spend less.
And that can directly hit companies' revenues and profits.
And when earnings fall short of expectations,
Stock prices usually follow suit.
it's a chain reaction. One thing takes a hit and everything else starts tumbling down.
Exactly. And to add to the drama, we have the 2025 election year.
Election years.
They always bring a bit of uncertainty to the markets, which investors don't love.
So buckle up, 2025 could be a wild ride.
You said it. But before we jump to conclusions, let's see what history can teach us about the S&P 500.
All right, let's dust off those history books. What kind of patterns can we see in the S&P 500's past performance?
Okay, so going all the way back to 1926, using data from macro trends.
Wow, 1926. That's a long time ago.
It is. There have been 11 times when the S&P 500 had 2 consecutive years of gains of 20% or more.
Just like we're seeing now.
Exactly. What happened in that third year?
That's the big question.
Well, the market was positive about 60% of the time.
So most of the time.
Sometimes with gains as high as 19.75%.
Wow, that's amazing.
But on the flip side, it was negative 40% of the time.
Oh, no. So there were some down years, too.
With the worst case being a drop of 35% back in 1937.
Whoa, 35%. That's a serious drop.
It was a rough year.
So basically, history tells us 2025 could be amazing, or it could be a bit rough.
The average return in that third year across all those instances is actually just 0.65%.
Which basically means it's probably not going to be totally average.
Right. That average hides a lot of variation.
But hold on a second. Doesn't this whole thing feel a little familiar? All this hype around AI and the stock market going crazy?
What are you thinking?
It reminds me of the dot-com bubble.
You're right. There are definitely some parallels.
Back then, we saw 5 years in a row of over 20% returns.
Fueled by the excitement around the internet.
Exactly. But eventually, that bubble burst.
Which is why it's good to approach this AI craze carefully.
History might not repeat itself exactly,
but it often rhymes.
So with all this historical data, how worried should we be about that 40% chance of a negative year in 2025?
It's definitely something to keep in mind, but here's the thing. That 60-40 split isn't that far off from the market's long-term trend.
How so?
Well, historically, the S&P 500 has been positive about 70% of the time, no matter what happened in the previous year.
So the odds are generally in our favor.
It seems that way. And it's important to remember that we're only looking at 11 examples here.
So we shouldn't overinterpret the data.
Exactly. It's just one piece of the puzzle.
Okay, so it's not a guarantee either way, but the odds are generally in our favor. All of this is fascinating stuff, but it can be overwhelming, especially for young investors just getting started.
I can imagine.
So let's move on to what you can actually do with this information. How can you use it to make smart decisions in 2025 no matter what happens?
That's the real question, isn't it? Let's get practical.
Let's do it.
You know, it's funny you should mention feeling overwhelmed because one of the articles we're looking at today from Forbes actually talks about how predicting the stock market is a bit like
predicting the weather.
Exactly. Sometimes you get it right, but a lot of times
you get caught in the rain.
Exactly. And the article points out that even the people who do this for a living have trouble consistently predicting what the market will do in the short term.
Yeah, that makes sense. So what's the solution? We can't just sit back and hope for the best, right?
We need to be proactive.
But how?
Yeah.
What are some things young investors should keep an eye on as we head into 2025?
Well, aside from checking the weather app constantly.
Good one.
One of the most important things is going to be watching what the Federal Reserve does.
The Fed.
There's the central bank of the U.S., and their decisions about interest rates have a huge impact on the entire market.
They're like the puppet masters of the economy, but hopefully with less creepy felt puppets.
Hopefully. But seriously, if the Fed keeps raising interest rates to fight inflation, it could create some headwinds for the stock market.
Especially for those tech companies we talked about, right? Higher rates mean higher borrowing, costs less innovation, less growth.
It all kind of snowballs.
So pay attention to what the Fed says and try to understand why they're making the decisions they are.
Exactly. It's about connecting the dots.
But it's not just about what happens in the U.S., right? The global economy plays a big role, too.
Oh, absolutely. What happens in Europe, Asia, anywhere can affect the market here.
So we can't just put on blinders and focus on our own backyard. We have to be globally aware investors.
Exactly. For example, if there are political tensions in another part of the world, or if a major economy starts to slow down, that can create uncertainty and volatility in markets, which can trickle down to the S&P 500.
Got it. So stay informed about what's happening around the world. What else should young investors be thinking about as we head into 2025?
Well, think about the different sectors and industries within the S&P 500.
Okay, so we're getting even more granular now.
Yeah, because some sectors are more sensitive to changes in the economy than others.
Like we'd already talked about tech being sensitive to interest rates. What's another one to watch?
Consumer discretionary.
Consumer discretionary, what's that?
These are the companies that sell things that people want but don't necessarily need.
So like restaurants, entertainment, vacations.
Exactly. The stuff that makes life more fun.
So if the economy is doing well and people are feeling good, these companies do well.
That's the general idea.
But if things slow down or inflation keeps eating away at our wallets, they might struggle.
Because consumer confidence and spending habits have a big impact on this sector.
So you want to pay attention to how consumers are feeling and how that might translate to their spending.
That's a great way to put it.
Okay, so we've got the Fed, the global economy, and specific sectors to watch. What about that Forbes article you mentioned? Did they actually stick their neck out and give a prediction for the S&P 500 in 2025?
Well, they didn't give a hard and fast number, but they did emphasize that while the market could keep going up, a downturn is always a possibility.
Okay, so no crystal ball.
No crystal ball. They actually said, and I quote, "The market will probably be up, but it might be down."
That's surprisingly honest.
Yeah.
Not very specific, but it's a good reminder that no one can predict the future with 100% certainty.
Exactly. They're basically saying, don't get caught up in trying to predict the unpredictable.
Instead, focus on having a balanced approach and being prepared for different scenarios.
Right. Be prepared for anything.
Okay, so what's the big takeaway for our young investors? Should they be stocking up on champagne to celebrate continued growth or building a bunker in case things go south?
Neither. I think the key is to focus on the long game. Don't freak out if the market dips.
Easier said than done when you see your portfolio value shrinking.
Oh, I know. It can be nerve-wracking.
But market fluctuations are totally normal.
They are part of the process.
So instead of trying to perfectly time those ups and downs, which is almost impossible to do consistently, focus on building a diversified portfolio.
Exactly. Make sure it aligns with how much risk you're comfortable with and your long-term goals.
So have a plan and stick with it, even when things get bumpy.
You got it. Ride out those waves, stay informed, and keep learning.
Solid advice. Now we have one more article to look at, and it's a bit of a time capsule. We're going back to December 2023.
Oh, wow. Back when we thought 2024 was going to be rough. This article from Investopedia is titled, "Here's How Much Wall Street Expects Stocks to Rise in 2025. Remember those analyst predictions we talked about earlier?
The ones that predicted a 10% gain for the S&P 500.
Yep, that's the one. This article gives us a peek behind the curtain and shows us how those analysts came up with their numbers.
Okay, I love a good behind-the-scenes look. Give me the scoop.
Well, back then, Wall Street was feeling pretty optimistic about the U.S. economy and corporate profits.
They were expecting good things.
They were banking on earnings growth, picking up for a bunch of different companies in the S&P 500.
So they were basically betting on the good times continuing to roll.
Pretty much. And that's why they were projecting more gains for the index in 2025. The article even quotes Morgan Stanley and Goldman Sachs, who both predicted the S&P 500 would hit 6,500 this year.
Bold predictions. And they weren't too far off, at least for now.
Right.
But we got to remember, these are just forecasts. They're based on a lot of assumptions about the future, and things can change quickly in the market.
Oh, they can definitely change quickly.
Unexpected events can pop up and throw even the best predictions off track.
It's like building a house of cards. One wrong move and the whole thing could come crashing down.
So it's important to take these predictions with a grain of salt and consider a range of possible outcomes.
Always good to have a backup plan.
So what does all of this mean for our young investors? Should they buy into the hype or prepare for a market crash?
That's the million-dollar question, isn't it? And unfortunately, there's no easy answer.
I figured as much.
The best thing you can do is stay informed, diversify your investments, and have a long-term strategy that you feel comfortable with.
So it's all about having a plan and being prepared for whatever the market throws our way.
Exactly. Investing is a marathon, not a sprint. By staying focused on your goals and making informed decisions, you can weather the market's ups and downs and build a solid financial future.
Love that analogy. Investing is definitely a long game, not a get-rich-quick scheme.
Couldn't agree more.
Before we get to our final takeaways, let's recap what we've learned so far about the S&P 500 and what 2025 might hold.
Okay, sounds good. Let's do a quick review.
First, we talked about the roller coaster ride the market has been on lately, with those big swings between gains and losses.
It's been a wild ride.
It's enough to make anyone's head spin.
And that volatility makes predicting the future even trickier.
Then we dug into those analyst predictions for 2025, which were all over the place.
Yeah, there's a lot of variation.
And we talked about how those predictions aren't always accurate. Remember, they thought 2024 was going to be much worse than it turned out to be.
Right. They totally underestimated the market's resilience.
It's like trying to predict which way a leaf will fall on a windy day.
Perfect analogy. We also emphasize that those predictions are based on certain assumptions about the economy and corporate earnings, which might not actually happen.
Nothing is set in stone.
Exactly. It's important to remember that nothing is guaranteed in the stock market.
Next, we discuss the main drivers of the S&P 500: corporate profits, interest rates, and inflation.
The big three.
Those are the big players you have to keep an eye on.
Absolutely. We compared corporate profits to the engine of the market, interest rates, to the gas pedal or brakes in inflation, to those pesky potholes that can slow you down.
And of course, we can't forget about the wild card, the 2025 election year. Election years always bring a bit of drama and uncertainty to the market.
It's always fascinating to see how politics and the financial markets interact.
Then we got into the bull versus bear case for 2025, looking at the factors that could lead to more growth or a potential downturn.
We covered a lot of ground there. We talked about the potential impact of the Federal Reserve's decisions on interest rates, the global economic outlook, and how well companies are doing, and even how optimistic or pessimistic investors are feeling.
To get a bit of historical perspective, we went all the way back to 1926 and looked at the S&P 500's track record.
History can be a great teacher.
We found some interesting patterns, like how the market tends to be positive about 70% of the time. But we also saw that there have been times of big drops in volatility.
Right. It's not always smooth sailing.
And we talked about how the current excitement around AI has some similarities to the dot-com bubble, which is a good reminder to be cautious even when things are looking good.
History might not repeat itself exactly, but it often rhymes.
Finally, we talked about some practical tips for young investors, emphasizing the importance of stay invested, diversifying your portfolio, and always learning more about the market.
Remember, knowledge is power, especially when it comes to your money.
Great recap. Now let's get to those final takeaways for our young investors. Okay, so we've covered a ton of ground today. Everything from, market trends and historical patterns to the forces that move the S&P 500. But let's cut to the chase here. What are the big takeaways, like the golden nuggets of wisdom our young investors should walk away with? What can you actually do to set yourself up for success in 2025 and beyond?
I think it's easy to get caught up in all the hype, the predictions, the day-to-day noise of the market.
This is definitely a lot to process.
It is, but the real key to successful investing isn't about trying to, predict every twist and turn.
So it's not about timing the market perfectly.
Exactly. It's about building a solid foundation and having a long-term mindset. Think of it like building a house.
You like that.
You need a strong foundation to weather any storm.
So what are those key building blocks for a young investor?
Well, the first one is super simple, but it's crucial. Time.
Time.
The younger you are when you start investing, the more time your money has to grow.
Okay, that makes sense.
And thanks to compounding, even small amounts invested consistently can really add up over time.
It's like planting a tree. The earlier you plant it, the more time it has to grow tall and strong.
I love that.
Speaking of trees, I remember when I first started investing, I was so clueless. I probably couldn't tell a stock from a bond.
We've all been there.
I put a little bit of money in a target date retirement fund. It's basically a set it and forget it type of investment.
Oh, yeah, those are great for beginners.
And honestly, I totally forgot about it.
Out of sight, out of mind.
But then years later, I checked it, and I was shocked by how much it had grown, even though I hadn't really done anything.
See the power of time and consistency.
It's amazing. But before we even start putting money in, it's important to define your financial goals rest.
Absolutely. What are you saving for? A down payment on a house, early retirement, starting your own business?
All good goals.
Having clear goals will help you stay focused and motivated.
So it's like having a destination on a map.
Exactly. It gives you direction and purpose.
Once you know where you want to go, you can start figuring out the best route to get there.
Which brings us to diversification, right? Don't put all your eggs in one basket, even if that basket is the S&P 500.
Diversification is key. Spread your investments across different asset classes.
Like stocks and bonds.
Stocks, bonds, maybe even some real estate.
So don't put all your money in just one thing.
Right. Think of it like building a well-rounded team. You wouldn't want a basketball team with only point guards, right?
You need a mix of players with different skills to succeed.
Exactly. And diversification can help smooth out the ride during those inevitable market bumps. It's like having shock absorbers on your car.
To help you navigate those potholes without losing control.
Precisely. Okay, so diversify, check. What else? Risk management.
Risk management. So investing always involves some risk.
There's always some level of risk.
But understanding your own risk tolerance is key.
How much risk are you comfortable with? That's the question.
So how do we figure that out? Is there like a quiz I can take? Well, there are quizzes out there, but it's really about looking at your overall financial picture. How old are you? What are your goals? How comfortable are you with the idea of your portfolio value fluctuating?
Some people are okay with big swings, others not so much.
Right. Think of it like riding a roller coaster. How big of a drop can you handle before you start feeling queasy?
Ah, I love that analogy.
Mhm.
I'm definitely a roller coaster enthusiast, so I can handle a bit more volatility in my portfolio.
But if you're someone who gets motion sickness easily, you'll probably want a smoother ride.
Exactly. It's
Yeah.
all about finding an investment strategy that matches your personality and comfort level.
And speaking of learning and adapting, that brings us to our final piece of advice.
Hit me with it.
The world of finance is constantly changing, so never stop learning.
Keep those brain cells firing.
Stay curious, read books, listen to podcasts.
Like this one, of course.
Follow financial news, and don't be afraid to ask questions.
Knowledge is power, especially when it comes to your money.
Couldn't agree more. There are tons of resources out there to help you stay informed and make smart decisions. And if you're ever feeling lost or overwhelmed, don't hesitate to reach out to a financial advisor.
They could be a great resource.
They can help you create a personalized plan and navigate the complexities of the market.
So to sum it all up, young investors, remember, start early. Define your goals, diversify your investments, manage your risk, and never stop learning.
Those are the keys to success.
With those principles in mind, you're well on your way to building a brighter financial future. Who knows, maybe one day you'll be running one of those Fortune 500 companies on the S&P 500.
Now that's a goal worth striving for. Thanks for joining us on this deep dive into the S&P 500. We hope you found it informative and helpful as you embark on your investing journey.
Investing is a marathon, not a sprint. Enjoy the ride and make smart decisions along the way.
Wise words.
And hey, be sure to check out our YouTube channel, Dow's Stock Talk, for more insights and discussions on all things investing.
We'd love to hear from you.
We love hearing from our viewers, so leave your thoughts and predictions for the S&P 500 in the comments. Until next time, happy investing.
Happy investing, everyone.